this working? Hello? You can hear me? Dave, thank you for making that sound as exciting as it possibly could sound. I know some of you would rather see paint dry than to hear about this kind of stuff, so I'll keep it really as short as possible. A lot of you are here to look at companies that are really great companies. They've been going through our program, growing, showing great products, great development, and you might be asking yourself, how do I invest? And a large part of 500's presence here in Japan is not just building out an ecosystem in terms of companies and putting money to work. It's also providing the framework by which the larger investment community can actually put their money to work. So, when we started out at 500 Startups in terms of investing in the US, we also had a joint thesis about investing all around the world. And alongside that is the challenge of bringing what we do in the US to doing that in other parts of the world. And so we developed this agreement called the KISS agreement. And I'll explain what that means in a moment. But just to preface this, I want to say that a couple of months ago we launched the JKISS in conjunction with James and Yohei's efforts with 500 Japan, and in collaboration with KPMG. And I'm not really good at pronouncing this name, but Masakazu, which is a law firm in Tokyo, a top law firm for venture capital law. And through this collaboration, we've created a really great agreement that can help really facilitate venture capital investment in Japanese companies. So just to go to the next slide here, a little bit about myself. I'm 500's internal lawyer. I oversee all of our investments. I spent some of my life representing private equity funds and hedge funds and a lot of cool public companies. And then I went to Silicon Valley because I was sick of doing the PE hedge fund crap and representing VC funds, startups like Facebook, well, Facebook back then, Jet, King.com, Index Ventures, Excel. And now I'm at 500 Startups where I oversee all of our investments. We have over 1,500 portfolio companies, and I oversee all of our investments worldwide. So it's a lot of work. KISS stands for Keep It Simple Security. I know KISS means many other things to many other people, but that's what it means at 500 Startups. And the reason KISS is so important, at least in Silicon Valley, is that it's a really, really cheap and easy way to do deals. When you're doing an investment in Silicon Valley of, say, $100,000 or up to $1 million, you're looking at an investment that takes many weeks to complete. You're spending a lot of money on lawyers, and as a lawyer, I can tell you it's a waste of money. It's just a waste of time. And, Dave always repeats this mantra of time and money are the killer of deals. And I wholeheartedly agree with that. So we created the KISS in Silicon Valley as a way of just having this simple 5-6-page investment agreement that all the parties can agree is good enough for what it does, and it gets the job done. And we launched KISS in Silicon Valley. We use it for all of our accelerator investments. And ever since I started at 500 Startups, I've been trying to launch KISS all around the world. And it's been great. We have KISS in India. We have KISS in the UK. We have KISS in the British Virgin Islands. A lot of companies are incorporated there, so it's really helpful. KISS in the Cayman Islands, KISS in Mexico, KISS in Canada. We have documents in South Korea called START. We have KISS in Singapore and in Malaysia. And now we have the JKISS. Japanese, or Japan, Keep It Simple Security. Now, before the JKISS was launched, this is how investments typically took place. You would do a seed round, and you would have to have a lead investor. So you'd have to find some investor who'd be willing to put in a lot of money alongside you to invest in a company. The legal costs for the founder would be at least 500,000 yen, probably a lot more, per investor. That's a lot of money. And then the legal costs for an investor would be 500,000 yen at least as well. And it doesn't make sense when you're only investing, say, $50,000 to $100,000 to have fees that high. It doesn't really have, if I was trading stock and I was buying $100 worth of stock and I had to pay $10 of commission, that would make no sense from an investment perspective. So the transaction costs are really high. The difficulty level is high. The agreements are like 20, 30 pages long. You don't want to read them. They don't make sense. And you're paying some lawyer to negotiate meaningless terms that don't really have an impact on you most of the time. It takes a long time to close them, at least 3 weeks. But James was mentioning to me one deal he did in Japan that lasted 3 months. Imagine if you were writing a $100,000 check and it took you 3 months to close that investment. That's a lot of time. And the ignorance level is high. And I don't mean that in a bad way. I mean that to say that people don't care about this kind of stuff because it's so long and so dreadful and so boring. So I want to solve this. And that's what JKISS is meant to do. Investors can be anyone. If you want to be a smaller angel investor and you want to invest in any one of our companies that presented in this program, you can use this document. You can use this document for yourself only. You don't have to have a team of investors. You don't have to have a cabal of people who are going to sort of lead around or anything like that. It can just be you. The cost for the founder is maybe 50,000 yen, if that. The cost for you, again, maybe 50,000 yen. Those are your legal fees. It's a bargain. The difficulty level is low. The agreement is super, super short. It's available online. I'm going to share the link at the end. It'll take you, if the investor and the company are aligned on investment terms, it'll take you maybe 2 days to close this deal. So think about that. Low legal costs, super easy to read, and it'll take you 2 days to close, if that. And I only think it'll take 2 days because it maybe takes 2 wires for money to your bank account from the investor's bank account. Super easy. That's the purpose of JKISS. Now, the way JKISS works is you are not buying shares in the company when you invest via a JKISS. The JKISS is, put simply, a loan. It's a convertible loan, which some of you might be familiar with. And the way the loan works is, as an investor, you lend the company money. Say you lend $1 million. Then, say 1 year from now, the company starts to sell shares in the company for a certain price per share, say $1 a share or $2 a share, at a certain valuation, say a $4 million pre-money valuation. So what happens then is your debt, the money that you lent, will convert into equity in that company. And it's very simple math. You just take the amount that you lent and divide it by the price per share. That's how many shares you're going to get. It's very easy. And because you're such an early stage investor in this company, the best component of this agreement is that you get those shares at a discount. So potentially, if the company's selling shares for $1 a share, you could get shares at a 50% discount. And therefore, your money could convert at a 50% discount. It could convert at 50 cents a share. So you'll be getting double the shares. I think that's a good deal, right? So simply put, you are lending the company money. It starts out as debt, and then down the line, it becomes equity. Here are the key terms of the JKISS that I want you all just to know about. There's a bit more, but these are the most important aspects. I won't waste your time with any other stuff. There's no maturity date. So this is really good for the companies. They don't have to worry about not being able to raise money in time for the debt to convert into equity. There's no interest rate. So again, this is easy for you and easy for the company. We all know why we're doing this. We're not doing this to lend money and to gain profits from interest. We're doing this to gain money from multiples. We're doing this to get shares cheaply and then to sell them for a high profit. So we have 0% interest. The founder doesn't have to pay interest, and you don't have to accrue interest. You're looking at a discount of anywhere from 10 to 30%. That means that, if the investors, if the company sells shares for $1 a share, you could maybe convert at 70 cents a share or 90 cents a share, depending on what you negotiate. There's a valuation cap that serves as an upper limit as to what you'll pay for your shares. If, the company raises money at a, 1 billion yen pre-money valuation, and you have a 100 million yen valuation cap, then your money will convert as if it was a 100 million yen valuation. The company has to raise a minimum of 100 million yen to have the debt convert into equity. And finally, probably the most important component of this agreement is the acquisition premium. There's no other agreement in Japan that has this that's really good for investors. Basically, a couple of you in the audience might be thinking to yourself, what if I lend the company money, but the company does not have a financing round where this money converts into equity? What do I do then? What if the company is acquired before the money converts into equity? And that's very common in Silicon Valley. A lot of companies like Google, Facebook, Dropbox, Airbnb, they do things called acqui-hires. Well, they'll acquire the company prior to them doing selling shares in the company because they want to hire the founders to go on board at their company, at Google, at Facebook, at Airbnb, at Dropbox. But the problem for the investors is that typically in an acqui-hire situation, they only get 1x of their money back. And that's bad, right? If you invested 100 million yen today, and in 1 year you got 100 million yen back, that's a bad investment. You've lost money, right? And for a VC, that's even worse. You have to tell your LPs, your investors, your limited partners, that you got them only 1x back. And they'll laugh at your face. So our agreement has something called an acquisition premium, which gets you at least 2x of your investment back. So that means that before the founder gets paid, if there's enough money, you get 2x of what you invested if the company is acquired before the J-KISS converts into equity. Really cool, right? I mean, this is cool to me. Who really cares? But anyways, I want to explain in a little more detail 2 components of how this agreement works, so you have a sense of what you're getting into when you're investing in the companies that have come out of our Kobe program and companies that come out of 500 startups in general. So the way a discount works is very easy. Let's suppose you invested $1 million on a J-KISS. You invested it at a 20% discount. The company is raising a Series A financing at a $20 million pre-money valuation. That $20 million pre-money valuation might equate to a $2 price per share. So the price per share is $2. You apply the 20% discount to $2, you get $1.60 per share. If you divide $1 million by $1.60, you get 625,000 Series A preferred shares. Another investor who didn't get a discount, who just invested $1 million, would have received only 500,000 Series A shares. So you basically got 125,000 free shares. That's a lot of money. I'll take that. Now, the way a valuation cap works is similar. Let's say you invest $1 million on a J-KISS. The company's raising a Series A at $2 a share at a $20 million pre-money valuation. You've negotiated a $10 million cap. $10 million is 50% of $20 million. So you apply that percentage back to the price per share. It equates to an effective discount of 50%, and therefore you convert at $1 a share. And you get 1 million Series A preferred shares. Again, if you had invested $1 million with no valuation cap, you would have gotten 500,000 shares. You get 500,000 free shares in this scenario. That's pretty awesome. That's a lot of money. Now, typically, agreements have both discounts and valuation caps. So you're probably asking yourself, which one do I get? And my response to you is that you get the better of the two. Whichever gives you more shares, you get that. So I'm going to go to the next slide. Oh, well, this kind of previews it. But this tells you what you got to know. Investor gets the better of a valuation cap and a discount. The next slide is going to freak you out, so I'm just warning you in advance. It's going to be a lot of information, but don't worry about it, because you've seen this before. You've seen this in the last two slides. There's a big heart in the middle. Up here is what you'd get if you use a valuation cap, 1 million shares. Down here is what you get if you use a discount, 625,000 shares. You get the better of the two. In this case, what does the investor get if they invested $1 million? The answer? Pretty easy. This is a really important document, and we have already been releasing this online. You can go to this website. You can download the documents right now. They are available for investors to use. They are available for companies to use. There is no such thing about it being founder-friendly or investor-friendly. It's right down the middle. It's just meant to help out the market. And it was developed locally by Japanese entrepreneurs, Japanese investors, the community at large, Japanese lawyers, KPMG, and it was meant for the Japan market. Please use this agreement and save yourselves some money and get yourself even more money. Thank you.